Hi friends, welcome to the NPTEL course Strategy and Technology, a Practical Primer. We are in week 4 with the theme of competitive strategy. In this lecture, which is 17th in the series, we discuss the topic of economic forces. As we are all aware, economic forces have been overwhelming at national level as well as at global level over the last several years. The theory of competitive strategy, which forces our thinking in terms of competitive activities within the industrial framework, needs to be buttressed by integrating economic forces. The model of 5 competitive forces is certainly powerful and elegant. However, it doesn't reflect the current realities of economic and technological forces, both at national level and at global level. In future, these would only accentuate further. The second point is that the competitive forces cannot be viewed in isolation of each other, and they cannot be seen as independent of each other. They cannot be viewed in discrete silos. All the competitive forces have many interconnectivities and also many overlaps. We need to bring these things together in one holistic paradigm. Also, the firm-level competitive strategy becomes transformational when we combine the paradigm of economic forces, national aspirations, and technological changes with the conduct of industry structure and performance. Primarily, we must be recognizing the big differences between national economic forces and industrial competitive forces, and the differential impact these forces have on industry conduct and firm strategy. These economic forces influence structural analysis of industries as well as development of competitive strategies. As a recap, Porter's model talked about 5 competitive forces: threat of new entrants, threat of substitute products and services, bargaining power of buyers, bargaining power of suppliers, and intensity of industry rivalry. These analyses stemmed out of the industrial economic theories of structure, conduct, and performance. These 5 competitive forces vary based on the nature of the industry, the state of the industry, and the state of the firm. Porter also proposed 3 generic competitive strategies which we have considered earlier: cost leadership, differentiation, and niche. These help a firm derive sustainable competitive advantage over competitors. Porter did not explicitly consider economy or, for that matter, technology in this framework. I would say that Porter's strategy looked at microeconomic forces in great detail. Porter's strategy led to a very sharp articulation of corporate and business strategies compared to the woolly strength, weaknesses, opportunities, threats analysis that were in fashion in the 1960s and 1970s as part of the incremental long-range planning process that were existent at that point of time. In fact, I would say that in the domain of strategic management, Porter's competitive strategy led to a step function improvement in our understanding of firm and industrial level structures and strategies. However, whether the industry level microenvironment with which the Porter's model was completely aligned and in a way obsessed is still appropriate for formulating competitive strategy in the context of the kind of changes that are occurring in the macroeconomic environment and macro-technological environment over the decade of the 2010s. This is a structural reality which will increase in its impact over the next few years. The way the global economy anticipates US Fed rate hikes or the Indian industry is anchored around an RBI rate cut indicates that macroeconomic factors have an increasingly overarching influence these days. The liquidity provided by the central banks through quantitative easing and the manner in which the quantitative easing is rolled back have a great impact on how industrials perform over the years. Similarly, the way the slowdown in China causes global demand tremors and the manner the stock market blues or taxation issues fray or calm the nerves of portfolio investors in India are also proof of global economic and industrial interconnectivity. All the bourses, that is, all the stock exchanges which represent the collective behavior and thinking of companies and investors, are interlinked. no economy is now independent of another economy. And in the context of COVID-19 pandemic, it has become imperative that the socio-economic linkages across all the nations are well understood, and the macroeconomic policies and their relationship with industrial development is also well understood. We have to understand that Porter's strategy has to be viewed in an overall economic framework. Otherwise, we will be having microanalysis of industries without understanding the linkages with the macroeconomy of the nation. There are also other economic developments which keep arising from time to time and having significant impact on how the industry performs. One of these has been Brexit. Between 2017 and 2020, as UK decided to withdraw from the EU, Brexit began reshaping economic and industrial forces. Similarly, from 2018, when the trade war between US and China intensified, it destabilized the economic and industrial plans of different countries, industries, and firms. As the world's largest economy under President Trump followed a policy of protectionism from 2017, it set in motion broader protectionism in the developed world. Fortunately, many of the discontinuities are not those which cannot be reversed. They do not have a lasting impact. Nevertheless, they cause considerable volatility and uncertainty in global economic firmament. The short-term and medium-term impact of these events impacts the classic formulation of Porter's model. What is the baseline economic behavior? Generally, the baseline economic behavior is a steady-state economic behavior where every nation progresses based on its structural strengths and the budgetary policies the nation has. And these baseline economic forces are not included specifically in the industry-only approach of Porter's model. And over and above the baseline economic forces, we have unexpected economic impact through public emergencies, through pandemics, through geopolitical considerations, and so on. These are even farther from Porter's model. With reference to the baseline economic behavior itself, some peculiarities of India are as follows. 1. When we have initial public offerings as well as follow-on offerings and stake sales by public sector undertakings, we have stock market volatility. When the new age companies listed on Indian bourses, take it from Zomato and Nykaa to Paytm and PBFin, we see that there has been a significant volatility in the stock markets. There are ups and there are severe downs as well. And whenever there is an economic headwind, the volatility only increases. This has an impact on how industrial development takes place. Economic liberalization implemented progressively from 1992 has certainly freed industrial development from public policy, but as is evidenced by the linkage between industrial initiatives and policy initiatives like PLI schemes, that is production linked incentive schemes of the government, clearly there is still a big nexus or large nexus or a strong nexus between government policies and industrial development. And national and international policies more than ever impact industrial development. In a sense, there is no way to decouple the Indian economy and industry from global economic and political vagaries. But there must at least be a model that focuses the attention of firms and industries on such competitive economic forces. Therefore, there is a strong case for developing a model of competitive economic forces, just as Porter has developed a model of competitive industrial forces. This will take into effect in terms of the economic responses of different governments to emergencies. COVID-19 pandemic is a prime example. Let's look at COVID-19 impact and the aftermath. COVID-19 started in China in October 2019, but quickly engulfed the world in 2020 as a pandemic. The world as a whole is yet to recover from the pandemic. The Delta variant, which occurred in April-May of 2021 in India, has been strong in its impact and has led to considerable angst across the socio-economic situation as to how countries can cope with such a public emergency. But the resilience of the society, the resolve of the government have quickly stepped in to buttress the situation and help the society to come out of the eventuality. The impact of this has been negative for most sectors, but positive for sectors. Agriculture endured and supported India. So what happened when COVID-19 came in 2020? Economy contracted by as much as 25% in Q1 of 2021, but recovered thereafter. Industrial churn took place. FMCG, pharma and e-commerce boomed, while automobiles, electronics, hotels, travel and such others shrank. Unemployment was enhanced. Informal sector suffered serious job losses, while migrant labor was particularly affected. But today we also have a situation where people want to choose their jobs. There is this hashtag on great resignation that is going on in the United States. People are willing to forsake known jobs in search of newer types of employment and newer types of self-employment. So a public emergency such as COVID-19 has caused unknown impact across nations. Recovery scenarios have varied in 2020. Will it be a V-shaped recovery, U-shaped recovery or W-shaped economic recovery? Will there be multiple COVID waves in the context of the more transmissible Omicron variant which started appearing in the last quarter of this year, 2021? There is a lot of worry that there could be multiple COVID waves, even if they would not be so intense in their hospitalization impact compared to the previous Delta wave. So how would continued economic stimuli measures work? In fact, would there be continued economic stimuli measures because the central banks are wary of continuing the quantitative easing in the context of inflation, which is rising its head in various economies? Central banks have already announced their intention to taper the quantitative easing and curtail the liquidity that has been very prolific in the economic markets. The impact of COVID has been varied as demonstrated by the charts that follow. Spurred by the generous injection of liquidity by central banks, stock markets and startups zoomed regardless of the basic unsettled economies. Financial crisis always leads to economic loss. This is a very potent chart which showed how the employment changed when the different types of economic crisis or financial crisis hit different countries. Finland in 1991, US in 2007, US in 29, Sweden in 91, Spain in 77, Japan in 92 were all affected by the financial crisis, and you can see the job losses that happened, percent job loss from the peak that happened. Similarly, share of gross domestic product that is lost as a result of coronavirus pandemic in 2020 by economy also provides the telltale evidence of the economic impact of a pandemic. Low-income developing countries' share of GDP that was lost was 4.8%. Advanced economies 6.5%. In emerging markets 7%, Latin America 8.5%, and the world overall 6.7%. As I said before, the economic impact of COVID-19 was unprecedented and truly global. Every economy was adversely impacted by the economic lockdowns and social immobility caused by the pandemic. India's GDP contracted by as much as 25% in the first quarter of fiscal 2021 and by 7% for the full year due to the recovery in the second half of the fiscal. In the year 21-22, the expectation is of 7.5% increase. Particularly in the first quarter of 21-22, there has been impact due to the Delta wave. Although the country and the broader countries learned how to live with COVID-19 pandemic, even if it has been there in the spread. What was the global response to COVID-19? To battle the unprecedented impact of the global COVID pandemic, central bankers, especially of the developed world, injected massive amounts of liquidity into the respective economies, leading to a multiplier effect. What did it comprise? Massive liquidity injection. US, EU and Japan exemplified this. Notable stimulus in cash and kind and various initiatives, India. Incentives for industrial expansion, again India. China plus one strategy by the developed world. Focus on pharma diagnostics and healthcare across the nations. Global endeavor for the fastest possible rollout of COVID-19 vaccines. This has been the clustering of various responses by multiple governments across the world. Because of the liquidity push that has happened, stocks emerged from COVID crash with a historic 12-month run which continued well into 2021 until the recent times when US Fed and other central banks started announcing their intention to rein in liquidity to combat inflation. Despite the countries experiencing repeat COVID-19 waves in 2021 and India itself facing a severe second wave in April-May 2021, the world adjusted to the economic changes with no real clarity on long-term growth prospects. That has been the global response map to COVID-19 and the economic impact. Economic impact was moderated by the massive liquidity that has been provided by central banks. Let's look at the policy responses to COVID-19. Various economies responded to COVID-19 in terms of strong financial stimulus measures. They all tried to boost liquidity through bond purchases and investments through low zero interest rates. India also extended several financial and industrial stimulus measures. In Australia, the fiscal stimulus amounted to as much as 13.75% of GDP, and the monetary and macro-financial measures comprised interest rate reduction, bond purchases, tax rate cuts. In Brazil, the fiscal stimulus was of the order of 12% of GDP. Liquidity improvement measures, loan moratoriums and deferments were the key measures. In Canada, it was as high as 18.5% of GDP. Interest rate reduction, loan accommodation and bond purchases were the key drivers. In China, fiscal stimulus was lower at 4.7% of GDP because the overall economic and industrial strength was protected through very strict zero-COVID policy adopted by China. Liquidity through open market transactions, interest rate reductions, credit expansion, loan repayment deferments took place in China. In India, the fiscal stimulus was of the order of 10% of GDP. However, there were several incentives to stimulate industrial production, which probably was in the range of 6 to 8% of the GDP. These were very unique to India. Free food grains supply, micro, small, medium enterprise support measures, LTRO, CRR cut, SLR increases were the monetary and macro financial measures. In Japan, this stimulus was as high as 20.9% of GDP. Government purchased bonds heavily. It also purchased commercial paper. ETFs and REITs were purchased. Concessional loan facilities were extended for small enterprises. Capital infusion was done into banking sector. In Korea, the stimulus was of the order of 10% of GDP. Again, there was a strong financial stabilization plan, purchase of bonds, ease of financing of exports, industry stabilization fund. You can see how economic measures focused on flow of liquidity into the industrial sector because the spread effect of industrial development is going to be uniformly felt across the nation. That has been the policy of the central bankers. In USA, the highest stimulus country, 24% of GDP was in terms of fiscal stimulus. In addition, USD 1 billion of additional protections was provided. Lowering of federal funds rate, enhanced credit facilities, liquidity enhancement and loan support facilities, mortgage forbearance, etc. were the key drivers. These measures taken by the central banks and the governments had a salutary effect in terms of alleviating the pain caused by COVID-19. The interest rates, mostly repo rates, in 2020 were kept at very low levels by central banks of the developed world. Even negative rates were introduced. These have been the principal plank of stimulating business sentiment, apart from enhancing the liquidity substantially. You can see that US Federal Reserve kept the interest rate at the low of 0.25%. We have European Central Bank at minus 0.5%, Bank of Japan at minus 0.1%. So different countries have different rates of interest at low level compared to the pre-COVID levels. Reserve Bank of India kept the interest rate at 4%. And some economies which are prone to hyperinflation, such as Argentina and Turkey, of course, had high interest rates, but they were lower than what they were pre-COVID. India's Reserve Bank of India took the lead in stabilizing the economic and industrial situation in the wake of COVID. The RBI cut the rate by a whopping 1.15% in two tranches, which is a highly unusual step in the Indian context, where inflation is the primary policy driving consideration. So when we look at the economic forces, we can easily understand that there is connectivity with an impact on competitive strategy. Economic linkages are of two types: ongoing economic linkages and exceptional economic linkages. Ongoing ones are the regular fiscal and monetary policies, savings and instruments. These are incremental and annual in terms of their variations. Exceptional ones are liquidity injection, stimulus and focused investments. These tend to be massive, episodical, swift and exceptional. The need is for a model that captures economic forces, covering both ongoing and exceptional occurrences in terms of key economic forces and their impact on the model of competitive strategy. I propose a model of 5 economic forces which would impact industrial structure and performance. This is my model of 5 economic forces. We have power of global capital flows. We have the threat of inflation. We have the bargaining power of national markets. We have the bargaining power of national technologies. Together, these also lead to intensity of national rivalry. Just as we have 5 industrial forces, we have 5 economic forces. Each of these has an impact on industry level structure and firm level competitive strategy. They also dictate a preferred drift in the generic competitive strategies based on the combined risk and reward profile of the forces. This is a contribution I am making to the theory of competitive strategy with an economic framework. Let's look at each of the 5 economic forces, understand the impact of the economic force on industrial structure, both from the positive and the negative side. Liquidity flow is a force. High liquidity flows obviously boost the stock markets and enable industrial growth through multiple means, whereas low liquidity can turn investors away from equity and investments. Industrial growth suffers. Inflation risk. Low interest rates encourage continued liquidity and debt-driven industrialization. And with more purchasing power in the hands of the people, inflation raises its head. High interest rates lead to tightening of interest rates and increase the overall cost of capital. So, if the inflation is high, central banks are tempted to increase their interest rates. This increase in the interest rate leads to a tightening of the interest rate regime and increases the overall cost of capital and works towards negative industrial development. Market potential. The strength of the market, that is the size of the national market, example China and India as striking examples, attracts global players into the national economy. Whereas if there is a plateau in the market size of an economy, it makes a nation less of a globalized partner vis-a-vis other attractive nations. Technology power. This power goes beyond monetization through fees and royalties. It establishes exclusivity of a nation. Lack of technology makes a nation dependent. A national economy and its constituent industrial economy becomes dependent on those who have technological strength, those who have proprietary technologies. They are becoming dependent on technology providers in such a scenario. National rivalry works to the benefit of technology and liquidity providers. Low national rivalry is a negative for healthy globalization and diversified industrialization. Nations must compete just as firms compete, so that liquidity, technology, economic support, financial flows move towards markets which are strong, robust, and capable of absorbing all of this. Each nation and industry generates or responds to economic forces based on the velocity and intensity of the economic forces, the strengths of the national economy and industry in each case. So the sum total of all these forces of economy and the basic strengths and weaknesses of the national economy and national industry dictate the overall course of industrial development in a nation. The model of five economic forces can relate to global forces as well. Economic forces are global as well as national. In terms of global economic forces, we have exchange rate mechanism, we have bond yield mechanism. Relative impact of exchange rate and yields impact the direction and quantum of investment flows. At the national level, we have interest rates and bond purchases. Each nation may set its policies on stimulus, but global factors will impact the national stimuli. The references to taper tantrum that spooked markets after the unwinding of the stimulus measures that were initiated in the global liquidity crisis of 2008 to 2010 could cast a similar shadow when the economic stimulus is withdrawn in 2021 and 2022. There could be a massive global impact of the developed world stimulus drying up. The model of five economic forces, therefore, needs to be developed proactively to imagine what kind of economic forces would work in the coming months and coming years and how these forces would impact the industrial structure. Let's look at the national technology market interplay. Nations have a major role in licensing or attracting technologies. They can have major bargaining power because of their national technological strength, and this is countered in part by the bargaining power of national markets. If a nation has both technological power and market power, it would be really a superpower. In some cases, the market power would be very high, technological power is under development. India is an example of highly conscious and highly global national market power. Every country in the globe would like to participate in the Indian national market. The market is so huge and so visible. The technological power is evident in terms of the frugal engineering capabilities, but we need to have greater technological power in core technological and sunrise technologies. That is being observed by the governmental authorities, and they are taking steps to bring in latest technologies in several sectors such as semiconductors, drones, and so on. The interplay between technology and market forces is evident in military technologies. For example, the Rafale aircraft deal between France and India are opening up of the foreign direct investment in defense and other sectors subject to Make in India covenants. So if someone wants to have an outlet in India for the defense supplies, they also have to agree for Make in India initiatives, which will only increase absorption of such technologies by the Indian manufacturers. Globally too, national efforts extended to high-end civilian technologies as well. For example, China's efforts to promote its high-speed rail technology as an alternative to the Japanese and European technologies worked to some extent in several countries. Similarly, the enthusiasm at industry level to partake in Indian markets was evident when US technology firms vied with each other during Prime Minister Narendra Modi's visit to the US West Coast in September 2015 and thereafter. When nations compete to participate in emerging markets, rivalry is heightened, but that extension of rivalry happens to the benefit of the local industry. Governments can and must leverage such international rivalry for national benefit. India, for example, can benefit from generating international interest and rivalry for building bullet train infrastructure or creating new smart capital cities or for semiconductors and such high technology items in India. Before applying Porter's five forces theory or competitive strategy, one must therefore apply the five economic forces theory to establish the appropriate perspectives for firm-level competitive strategic analysis. That is the thesis of this particular lecture. We can have therefore a model within a model. The major differences between national economic forces and industrial competitive forces are as follows. The national economic forces are more volatile and unpredictable, whereas industrial competitive forces are more predictable. National economic forces are susceptible to public policy and government actions as well as geopolitical vicissitudes, whereas industrial competitive forces are swayed by changes in the economic policy framework. So the economic umbrella that overshadows the competitive structure of an industry is something which we need to recognize, but we need to have further research on how the economic forces model can be linked to the industrial forces model. One option for this could be to choose a time horizon that starts with a major economic inflection point, models the industrial forces until the expected next inflection point, and develops a calibrated industry and firm level model for the target time frame. That is one way to link the national economic forces and industrial competitive forces. We have to recognize that these two types of forces have interactive effect. National economic factors tend to be more unpredictable than industrial competitive factors. Per contra, industrial competitive forces and industrial development actions could have the ability to buffer or smoothen the effect of the volatile national economic forces. So both ways we have to view the interaction. In the ultimate analysis, the issue is not one of choosing between the micro model of Portal or the macroeconomic model that is proposed here. The macro model is the missing piece in the current strategy framework and must therefore be expressly provided for as suggested herein. For India at this point, a combination of competitive economic forces sets up the 5 economic forces model. 1. Variations in inflation. These are related to strong RBI rate policies, as has been evident for some time now. Second, fluctuations in global portfolio investments. These fluctuations are driven by global liquidity and quantitative easing considerations, which are influenced by central banks of various developed countries. Dependence on foreign technologies. This is for next generation infrastructure. Consumerization of markets. That happens with increased purchasing power. As India develops into the world's largest economic power in terms of rankings, then there would be increased purchasing power. We are expected to be the third largest economic power by 2025, and that would place enormous increase in GDP and also place enormous purchasing power in the hands of consumers. That would lead to better industrialization. Virtually every developed country wants a share of India. Therefore, there is an increasing level of national rivalry to enter or expand in India. Economic pragmatism has replaced policy dogmatism of countries. In addition, Porter's micromodel remains relevant but with 2 caveats. First, industrial play is not only about forces of competition, it should be about forces of collaboration as well. Secondly, the 5 competitive forces and the entities causing them are not independent of each other but could have accentuating or attenuating overlaps. So these are the linkages that exist in the industrial forces model with the economic forces model. There are also other updates that are required for Porter's model. Michael Porter held that the definition of the industry in which a firm operates in and the levels of entry and mobility barriers within and across the industries influence a firm's competitive strategy to a significant extent. The theory has been path-breaking, but there are certain critical shortcomings, especially with reference to contemporary industrial development. These are explained here. The first shortcoming is in viewing buyers, suppliers, and competitors as distinct, unrelated entities. The reality is that they are interrelated with the incumbent industry, but also with other adjunct industries. And firms tend to be common suppliers. Firms can be producers and consumers. Firms can be competitors as well as collaborators. The second is the proposition that the higher the entry barrier, the greater the value or profit potential. May not be so. It is very difficult to enter the steel industry because of the investment intensity. That doesn't mean that the steel industry would have higher profitability compared to, let's say, FMCG industry, which has low entry barriers, or a food delivery industry, which has even lower entry barriers. The third is the idea that industrial or environmental volatility is low and predictable, and therefore firms can plan their competitive strategies based on structural designs. This is also not true. Fourthly, and more importantly, Porter's model is not calibrated to address contemporary economic realities as has been outlined until this particular time. Porter also proposed that strategies of integration and diversification within an industry influence and are influenced by the five forces. While Porter's theory of competitive strategy represents a domain at the intersection of industrial structure and business performance, we also need an integration with the theory of economics, which will provide further strength or weakness to the Porter's industrial forces model. The new realities, therefore, are that buyers, suppliers, and competitors have multiple overlaps. In an industry, firms competing at the product level tend to collaborate at the component or material level. Industrial structures also do not follow conventional management principles, as economic forces impact the structural economics. So, there are three factors we can consider. Firms may look for sourcing advantages or cost savings, brand premiums, sales discounts, design independencies, etc. But they have to be aligned to maximize the overall throughput individually and collectively. That is, the entire ecosystem should try to maximize the throughput individually and collectively. The smart device industry is a classic example where multiple layers of collaboration at the component and system level exist amidst competition at the product level. We cannot really decipher which competitor products are within a particular smart device. Sony and Samsung could be competing, but Sony camera sensors are within Samsung products, and similarly Samsung displays are on Sony's smart devices. Apple and Samsung exchange their components so that there is one uniform product outer layer, but internally whoever is capable of producing those components in a differentiated but economic manner wins in terms of global supplies. The second factor, entry barriers need not necessarily represent value building opportunity. As I said, the steel industry might have the highest investment intensity and hence the highest entry barriers. Even the technology is very sophisticated, but it typically operates with only meager returns compared to low investment industries such as FMCG. Thirdly, as I discussed in the previous slides, industry structures are increasingly getting affected by economic trends, and economic trends themselves are getting affected by commodity and liquidity cycles. The volatility in crude prices, the volatility in metal availability, metal supplies, these are only likely to go up further. As nations turn towards renewable energy, the low emission vehicles, the journey is not going to be easy. The key materials, metals, precious metals that are required for these sunrise technologies and the new generation products which will occupy the mainstream industrial development are severely constrained. These materials are not easily available. Similarly, liquidity cycles, cross-border investment, and exchange rate regimes are all becoming increasingly volatile. These affect the stability of strategies. Over and above that, we have got other factors such as cryptocurrency. Governments are yet to take a stance on how to use the cryptocurrency. Are they an aid to the economic development, or are they going to be disruptive to the economic development? Will they be used in 100% legal manner, or will they be safe havens, at least in part, for some non-legal, illegal means? These are the questions which the central bankers are seized of, but a policy is yet to be laid down, either nationally or globally. Therefore, there are many uncertainties from an economic point of view which are yet to be played out. What has been played out are economic uncertainties and forces related to those which will affect public order because of pandemics, or those which will happen because of companies failing due to unexpected and exuberant, irrational industrial behavior that happened in 2008-2010. The steel industry requires a super commodity cycle driven by economic forces to pay the debt and achieve profitable self-financing. But it is easier said than done. So with COVID-19 exerting serious economic impact in different manners on different industries, structure and strategy will undergo major metamorphosis depending on the industry. The new realities could also combine two or more competitive forces into one competitive force and accentuate their combined impact. For example, new firms could enter an industry with substitute products or services, not just similar products or imitated products. Therefore, the competitive intensity will be exponentially increased. Buyers may start dumping their products in product exchange or refurbished product schemes, thus making firms substitutional rather than incremental sellers. That is, the trade-in scheme as a concept undergoes significant leg up. Therefore, incremental demand is less and replacement demand is more. That also impacts industry structure. Another example, an automotive design strategy developed at great cost for maximal fuel economy may become less powerful in a protracted phase of extremely cheap oil prices. That could happen. Industry rivalry could be more intense due to exit barriers, absence of quick bankruptcy provisions rather than low entry barriers. Commodity and other economic cycles may vary the impact on strategies such as cost leadership at the design or manufacturing level from time to time. Low global metal and mineral prices can completely alter the economics of firms in related product spaces. China's exit from basic chemicals may present exceptional opportunities that Indian firms may have failed to anticipate adequately and in time a few years ago. COVID-19 induced China Plus One strategy and climate change compulsions provide a new opportunity for the Indian chemicals industry, pharma, specialty and fine chemicals. We can go on and find out several examples which could have their origins in the changing international dynamics of both economy and geopolitical considerations. With this, we come to the end of this lecture. I feel that I have presented an economic forces model which is all-encompassing and through which prism we must look at the industrial forces model and the linkage between the economic forces as I have outlined, the 5 economic forces and the industrial forces model that we have studied in the previous lecture is important to set the right context for industrial development in the contemporary times as well as in the futuristic time. So thank you for your attention. Look forward to seeing you in the next lecture.